Hello, everybody. In this session, we are talking about fixed assets. Fixed assets refer to long-term tangible assets that are used in the operations of a business. They provide long-term financial benefits, have a useful life of more than 1 year, and are classified as property, plant, and equipment, or double P&E on the balance sheet. And then we move to the key characteristics of fixed assets. The first characteristics is fixed assets are generally tangible, physical things that have a useful life of more than 1 year. And then the second, fixed assets are subject to depreciations to account for the loss in value as the assets are used, with the exceptions of land. And then third, they provide long-term financial benefit to the business and aren't sold to customers. And fourth, they are regarded as being illiquid, in that they can't easily be converted into cash within a year. And then the types of fixed assets. The first types, tangible assets. Tangible assets is an asset that has a physical existence. Tangible assets examples are land, buildings, and machinery. And then the second, intangible assets. Intangible assets is an asset which doesn't possess a physical existence. Brand recognitions, intellectual property, goodwill, and such as copyright, trademarks, and patents are all examples of intangible assets. And then we move to fixed assets formula. Net fixed assets we can reach by, we know, the total fixed assets minus by accumulated depreciations. And then why are fixed assets important? Fixed assets are essential for several reasons. They can, we start from the first, help a company provide services and goods to customers and generate revenue. And then the second, indicate that a business may be in a high growth mode. And then the third, educate creditors and investors on the financial health of a company. And then benefits of fixed assets. Fixed assets are included on a company's balance sheet, but their benefits don't stop there. The accounting treatments of fixed assets influence income statements, statements of cash flows, and tax returns, where the benefits they impact are the result of capitalizations. There is how fixed assets benefits flow through each type of financial statement. We start from the first, balance sheet. Fixed assets are followed by investors assessing the value of a company and are shown in the non-current asset section of the balance sheet, net of the associated accumulated depreciations. This net value reflects ongoing reductions in value as the fixed asset ages. And then the second, statements of cash flows. There are two ways fixed asset treatment benefits are reflected in a company's statement of cash flows. First, the depreciation expense that was included in net income on the income statement is reversed on the statement of cash flows since it is a non-cash expense. Doing this helps maintain focus only on cash expenses for purposes analyzing liquidity. And then second, all fixed assets, especially second, all fixed asset activity is contained within the cash flows from investing activity action of the statement of cash flows to separate it from continuing operations. Although fixed assets are fundamental to operations, purchasing and disposing of fixed assets are unique, non-recurring transactions, so it helps to capture the activity separately from the day-to-day operating activities. And then the third, income statements. While fixed assets appear as part of the balance sheet, the related depreciation expenses are shown on the company's income statement. There are several depreciation methods that comply with the generally accepted accounting principles, or GAAP. And then we move to depreciations of fixed assets. Most businesses buy assets because they need them for their operations, which means they only have value to the business for as long as they can be used. Businesses know how long this is likely to be when they buy them. They therefore reduce the book value of the fixed asset each year over its life cycle. This is known as depreciations. Depreciations has two advantages to businesses. First, it gives a relatively accurate reflection of the asset's contribution to the business. Fixed assets tend to deliver the most value when they are new. As they age, they may begin to suffer from wear and tear. Even if they don't, they are likely to be superseded by other options. Eventually, they need to be replaced. And then second, depreciation allows a business to account for the cost of an item over 2 or more years. This avoids fluctuations in its financial statements every time a new fixed asset is purchased and thus gives a more realistic view of the business overall performance. For completeness, non-current assets are also reduced in value over their useful life. As non-current assets are intangible, the process is known as amortization. Current assets are not subject to depreciations or amortizations because they are expected to be used within a year. I think it is enough for this session. And thanks for watching, and don't forget give this channel with your like, comment, subscribe and share. Thank you.